Let's connect with Manishi Chaudhary. He represents BNP Paribas. Manishi, are you scratching your head trying to figure out what has changed? Why markets are up more than 3% this week?
Well, I don't know about the short term. There's no tool in fundamental analysis that, equips the fundamental analyst to predict or, explain these short-term movements. But at the same time, if you look at what we have been expecting for the market over the long term, that is over the last 1 year or so, we've been expecting about, this 20 to 22% return. Market has done slightly better than that. It's up about 25, 26% this year, but it's pretty much in the same ballpark. Recall that in early 2012, in fact, specifically on 3rd of January 2012, when we brought out our report on the outlook for the year, our target for the Sensex was 18,500. We didn't change it all across the year, despite there having certain, important developments domestically, particularly on the policy reform side. We maintained that target, and now, with about 1 month to spare, the market has gone beyond that target. I think, in general, the investors should have anticipated that Indian market would be a better performer this year compared to rest of the pack in Asia or emerging markets, and there are two simple reasons for that. Number one, there are several companies, notwithstanding what was happening in the economy in terms of this 5 or 5.5% GDP growth, etc. There are companies that were doing exceedingly well. They were generating cash thanks to the fact that they had cut down on their costs tremendously. And secondly, many of these companies were trading at, almost historic low valuations at the end of 2011. And that, I think, investors should not have ignored, or at least investors who have not invested in India. The FII investors have pretty much gained from this phenomenon. They have been the biggest investors in India. They're on a record high, about $20 billion till here. That's almost 50% of the entire Asia ex-Japan flow into Asia. And, I think it's really been a year of the FIIs who have gained, not just from their exposure to the market, but also from selecting the right stocks at the right time. In the first half, they were bullish on the defenses, like consumer pharmaceuticals, the consumer banks, etc. And from the July-September quarter onwards, they focused more on the domestic cyclicals, or the high beta names, which are really appreciating now. So, yeah, I think, it's been a bit of an unexpected year, but at the same time, I think careful stock picking and sector selection have generated returns and should have been anticipated to some extent even earlier.
Manishi, what is it that you like out of the pharma space, in particular between Sun Pharma, Cipla and Lupin?
Sun Pharma is clearly our favorite at this point of time. It perhaps combines the best of both worlds in terms of the catalyst, in terms of the overseas markets, consequently earnings growth going forward, and the valuations. In general, if you look at this pharma space, they're likely to benefit both from growth in the overseas markets and also because of the currency, because I think the currency is likely to remain, just about range-bound or possibly with a weak bias over the medium term, and therefore the exporters like IT and pharma are likely to benefit. Having said that, pharma is a sector where there is a divergence between stocks, both in terms of growth and in terms of valuations. So one has to be careful about stock picking. Our pecking order is actually Sun Pharmaceuticals, Cadila Healthcare, and Dr. Reddy's Labs, in that order. But among the large cap stocks, clearly Sun remains our favorite.
Manishi, I've got 3 research reports in my mailbox today. One from Citi, the second one from Goldman Sachs, and the third one is from Nomura. And all your counterparts are making a case that it's time to go easy on quality and it is time to focus on beta.
Well, I would tend to agree on that. It has been our stance also. You would recall that, we rebalanced our model portfolio sometime in early October. I think the date was around 5th of October. And at that point of time, we went significantly more into the high beta stocks. So it was reflected in our overweight on automobiles. It was reflected in our overweight in engineering and construction. And on the banks, even though we were not overweight because of a complete absence of the public sector banks, we did move more into the high beta private sector banks like ICICI Bank, and also into the NBFCs like LIC Housing Finance, Power Finance Corporation, etc. And many of these banks are also infrastructure proxies. Like we have Power Finance Corporation and IDFC in our portfolio. So yes, I would tend to agree with that switch. Market has moved up very sharply in the last few days, so by the natural process it may correct also somewhat. But you know, if you have a medium-term outlook, maybe a 6 to 9 month outlook, I think you know, the high beta domestic cyclicals, which you know, don't really have any management quality or corporate disclosure related concerns, they're really likely to do well. And I think investors would be advised to move more into those names.
Okay, just want to monitor what the banking pack as well is up to. Can we have the Bank Nifty good going in yesterday's session, scaled up quite nicely for the Bank Nifty, and this morning as well. It's maintaining that level of 12,100 plus levels. It's a good 0.5% gain coming in. Separately, Manishi, I mean, how important or significant is going to be the GDP data which is slated to come out today?
Well, I mean, the consensus number seems to be somewhere around 5.3 to 5.4%. It's not too different from what we are expecting. Our forecast is also 5.4. But, you know, I mean, these aggregate numbers, GDP growth or IIP growth, they're gradually becoming less relevant. You know, one reason is that there's a lot of data quality issues. In IIP, for example, you have one particular segment, capital goods, that keeps on fluctuating wildly. There are lots of revisions to these numbers going backwards. You know, even numbers that had been declared about 3 months or 4 months back, they tend to get revised. And they're kind of unrecognizable, you know, after about a 2 to 3 month time lag. So we tend to focus on the more high frequency data that comes out from the industry. You know, so the bottom up indicators like, you know, port, you know, freight traffic data, or you know, how many million tons of cement are being bought and sold, how many passenger cars and two-wheelers are being purchased, and you know, so those are the kind of data that we tend to track on a lot more frequent basis. And I think that is right now indicating that there is some mild upturn in domestic demand, particularly on the consumer discretionary side, maybe seasonal, influenced by the festive season that we've just gone past. But it could also lead to some kind of an industrial recovery with a time lag. I don't really expect that to happen in the first half of 2013, but possibly it'll be concentrated in the second half of 2013. But you know, in addition to this demand-led recovery, if the Reserve Bank of India is also able to generate a signal of you know, sustainable loose monetary policy around the beginning of next year, I think that could combine to give rise to an industrial recovery in the second half, and that would really you know, mean that all the moving parts as far as the Indian market is concerned are falling in place, and well, that's possibly the best outcome that we can look for.
So, Manishi, before we wrap, give me just one money-making idea for someone who wants to bet big. Give me a poker strategy. One stock where he can go all in.
Well, you put me in a spot.
Come on, that's an easy one for you.
I would.
No, that's an easy one for you.
Yeah. I would stick my neck out and say ICICI Bank. If I, you know, talk about the combinations of things that I talked about, you know, that is some degree of demand recovery, industrial recovery with a time lag, maybe in the second half of the year, and you know, the valuations that this particular company is trading at, and the kind of, you know, change in DNA that this particular management has had over the last 3 years, then I think, you know, the private sector banking universe in general would be doing well this year, and among that, our top pick is clearly ICICI Bank. So if I were to give you just one idea for the next year, I would stick with ICICI.
What's your price target for next 12 months for ICICI Bank? What is your bull and bear case scenario for ICICI Bank for the year 2013?
We have a price target which is, I think, slightly above 1200, I think about 1225 to 1230, which means about 20% upside from here. Yeah? Now, having said that, some of these variables like, net interest margin and credit growth, particularly growth in the second half of the year, could turn out to be slightly better than what we are baking in right now. If that happens, then the bull case for this bank may even be somewhere close to 1300 to 1350, which is about 25 to 30% upside. The bear case obviously concerns the NPLs and the non-performing assets. As of now, that risk has been concentrated in the public sector banking space, but many of the assets that have been talked about, they have been lent to heavily, even by some of the private sector banks. And some of these, in the connection with some of these assets, even the names of ICICI Bank or Axis Bank have been talked about. So if that concern, kind of accentuates over the next 1 or 2 quarters, you could see this, possibly decline to somewhere, 1,000, maybe about 900 to 950. But I would think for medium-term investors, such decline would really constitute a good entry point. So I would not really get too worried about the longer term if we see such, declines in share price in the near term.